Okay, good morning, everyone. Thank you this morning for joining us for the Activeport Group business update. My name is Alan Chan for Bridge Street Capital. My colleagues Alex Sundage, Rod Clarkson and Gordon Glassford. Today we have Peter Christie presenting and he's the Chairman and CEO. This is being recorded and we'll answer Q&A after Peter's presentation. Over to you, Peter. Thank you.
Thanks, Alan. Morning, everybody. Today we're going to go through the quarterly revenue, a little bit of insight into the figures, but some of the feedback I get from investors is they really want to understand more about what we do. And so the format today is to talk about numbers first for the people that want to get a numeric fix and move on. But then I'm going to dig a little bit more into product and strategy and some of our achievements in the last 12 months so that we add some more colour to the depth of our product and the tech and what we're doing in the markets that we operate in. So if I start off with the FY24 year in review, the highlight of the year was that we made a profit. And I think for the last 2 years, that's been our core focus other than tech and generating revenue. So we really needed to get to profitability. The market for microcap tech companies has been tough. The capital markets, the actual customer side has been fantastic, but the financial market's been tough. And so we knew we needed to get to profit as quickly as we could. And we achieved that in FY24, which was fantastic. And there's no reason we can't do that again in FY23. To do that, we did take a serious look at our excess overheads. We reduced our operating overheads by 3.8 million, and I think we've got that to the right size now. I don't think there's anything else we could do to save money in the operating side of the business, but we've certainly optimised our technical capacity around the projects and the customer base that we have heading into FY25. The revenue was down 23%, and that was evenly spread across the software business and the MSP business. If I go back to the IPO days when we only had MSP revenue and we didn't have software revenue, we quickly ramped that revenue from $0 to $6 million on average over the last 2 years, every year, which means the MSP business is less of a focus for us. And certainly, as you see in the rest of the presentation, one of the objectives in FY25 is to roll the MSP business and the SaaS business together to leverage the resources across both groups and the product set. And so heading into FY25, we should be able to report just the software-driven side of the business and hear less about the MSP business as a standalone operation. The objective from here is to drive recurring revenue growth. In the software business for the first 2 years, we've had fantastic revenue and some fantastic telco customers around the world. And a lot of them have chosen to pay us upfront. So we've had some large multi-million-dollar cash receipts from our telco projects, which has been fantastic. But it means that we aren't building a recurring revenue base from those customers. What we're doing with the 9 telcos that we've got in front of us at the moment is focusing on that recurring revenue base. And so through FY25, we should be able to start on a quarterly basis reporting that recurring revenue number and showing that growing, because everything that we're doing across the 3 divisions of the software-driven side of the business at the moment is all about generating recurring revenue. And so we think about the achievements in the last 3 years since we listed. From day one, we created a team of senior network architects and software engineers and a very experienced sales team led by Steve Norris, who is was previously the commercial sales manager for TPG with David Teo. Steve and his team have been working diligently to close out telco deals around the world and been quite successful at that. And we have a really, really solid team of network architects and software engineers behind them to deliver these projects. Our software revenue ramped from 0 in year -1, 1 million in year 2, up to 6 million annually. And so that's been a consistent number over the last 2 years. This is $6 million of software revenue. And if I look back at all the other software-driven businesses on the ASX, to go from a standing start of 0 to $6 million a year in 3 years is quite an outstanding achievement. And I think what we'll see now is that revenue numbers start to ramp up into FY25, because if I look at our sales pipeline today versus what we had at the outset, at the moment we have 3 major enterprise telco customers. We've got 15 at the moment that we're working on. We've got 4 that we're literally deploying at the moment, and so we can see that customer base scaling up, and the recurring revenue number should follow. We established a product market fit in the telco sector. When we hit the ASX back in 2021, we were focused on a number of different vertical markets to sell our software into, and we certainly found a fit in the telco sector, the tier 1 telco sector. And so we've then engineered a raft of features around our product set that meets the needs of that telco customer base. And from that, we've built a pipeline of 15 major telco customers across 3 global regions. And that's really just the beginning for us. What we find is that our software now it's enterprise grade. It gets deeply embedded into a telco. It generates strong recurring revenue, and we have very little competition in the sector that we're tackling. This year, we focused a lot of attention on getting our SaaS platform live. Last year, we launched what we call Global Edge, which is our SaaS solution for wholesale. And we've been quite successful. We have 14 different wholesale channel partners like Imperium and others that are using our SaaS platform as a wholesale product. In the last month, we've launched the retail B2B interface for that same feature set. And in the next couple of months, you'll see us launch some very interesting products in conjunction with some of our partners, in particular Megaport, leveraging their virtual edge, which is integrated tightly with our B2B SaaS platform to achieve 2 things: to make it easy for our enterprise customers to self-service build a global network, but also for our telco customers to be able to leverage some of those partner networks like Megaports to deliver more reach of their national networks into other parts of the world that they currently can't do as easily as they will be able to do with our product. And so we think the relationship with Megaport is exciting, and we will be announcing a number of new features in our B2B product suite in the next few months that will demonstrate the strength of that product combination. We are also working very hard in the GPU streaming software space. We're up to version 3 of our GPU streaming software product. It is very, very tightly aligned with AMD. In the world of GPUs, you can purchase from NVIDIA and AMD is our preferred platform. We work very closely with AMD in building that product. We currently have it deployed in 24 telcos for cloud gaming. We have 70 contracted through our partner Radian Arc. And the next version of that software is to focus on the AI sector, but AI applications that have a interactive video component added to them. And of course, the last achievement, which is probably one of the most significant, is achieving operating profitability in FY23. And so if I think about product roadmap, our first phase of product development was to focus down on that telco and enterprise network orchestration solution set, and that's proved very successful. We've delivered a lot of revenue. We've got a lot of new telcos coming on stream. Some of the biggest telcos by user number in the world are now committed to using our product, which is fantastic. We delivered the first phase of our GPU orchestration software, was phase 2 of our development cycle, and we've got 70 contracted telcos where we're deploying that product, and version 3 of that will really be the one that packs a punch. I think version 3 of our GPU orchestration software will be a real game changer in the cloud gaming industry. We deployed our B2B Global Edge product, and so I think that is now complete in terms of feature set and scope, and now we'll just build out the capability of that software over time to deliver more recurring revenue on that base. It's a fantastic product. I'll delve into that a little bit more, but one thing about that platform is a SaaS solution. It's not a physical network, it's a SaaS solution. So our GP on the in-house services that we sell through our B2B portal is at least 75%. So it should produce not only solid recurring revenue, but good margins as well. And we're really at the end of that phase now, having just launched the B2B portion of our SaaS product. And so now we're thinking about phase 4, which will include, other than building depth into the existing product set, will include a little bit more focus on the AI inference into the market. And so when we think about product market fit, people say, what is the problem that we solve? Well, for the telco industry, telcos typically have a lot of mobile revenue and a 30%, maybe 40% in some cases of their revenue is enterprise revenue. So enterprise on net revenue. And over the last 5 years, a lot of that highly profitable enterprise revenue for telcos has come under threat from the hyperscale providers. People like Google are building probably more subsea fiber to connect continents than the telco providers are today. And so the cloud operators, AWS, Azure, Google, etc., are starting to eat into that highly profitable revenue from the telco providers. And that's quite a threat to telcos. Now, traditionally, telcos didn't need to think about selling their services in an online fashion and integrating tightly to the cloud and allowing their users to buy telco services like you would buy compute from AWS. But they can't ignore that anymore. And so most telcos around the world are trying very quickly to pivot towards a self-service model. Buying a network from a telco traditionally is a very, very manual process. It takes a long time. It can take months from the time you call a telco to when you can get a network provisioned. Whereas if you compare that to the experience in the cloud for buying compute and storage, you can just go to AWS and spin up servers and storage in minutes. And so what telcos have realized is they need to get to that place. They need to get to a position where they can deliver their network services instantly through an online portal, just like people buy compute and storage. And our software enables them to do that. And so when we talk to telcos around the world, they understand the problem. They understand they have to solve it quickly. And installing the Activeport product is the quickest way that they can get from a very manual process to a fully automated, online, instant self-service network provisioning situation. And so what we're finding with the enterprise telcos around the world is that we're having a highly, highly successful hit rate, that we're converting probably 90% of the telcos that we talk to using our product in some way, shape or form, mainly because of the urgency they have to get this done. And secondly, there just is not a lot of competitive product out there that has the feature set and the customer focus that we do. And so when you drill down another layer into then what do we do? Well, we deliver instant self-service portals for telcos. We enhance the service visibility of their customers. And so if you are a large customer of a telco, if you're BHP or Petronas or somebody like that, and you've got your network outsourced to Telstra or Orange or Telecom Malaysia, then you have limited visibility of exactly what's going on in your own network. And our software gives those customers a lot more visibility of the network that they're buying from the telco. And that gives them a sense of control and a lot more customer satisfaction. The telcos can bond their network into the cloud services around the world a lot easier with our product, because our product does interface to all of the cloud providers and cloud services through their APIs. And for the telco, it helps keep their customers on net. And on-net enterprise revenue for a telco is highly, highly profitable. The margins for on-net revenue can be 90%. And so having that traffic churn away to other providers is detrimental for a telco. And really what we're trying to focus on is help them reduce the churn and keep those customers on net, and certainly increase the level of customer satisfaction in their enterprise customer base. Now, people ask me about, well, what do we do? Do we just do a website? No, we don't. This is a complex, and I won't drill into it, but just to give people a feel of exactly what happens when we implement our software at a telco. We embed the software very deeply into the business. If you think about telco operation, to automate network provisioning, our software has to be integrated with their core network switching. And so our software talks direct to the core network switching equipment in a telco, which can be an extensive network, definitely national, most times international as well. And so our software is tightly integrated with network operations. But then for a customer to purchase a product, provision a product, monitor a product, change it, upgrade it, deprecate it, our software has to be integrated with the billing system, the provisioning system, the service desk system, and finally deliver all of that to the user as a portal that has full monitoring and cybersecurity capability. And so by the time we're finished implementing our product for a major telco, it's very deeply embedded in the business. And And on successful delivery of that, where a telco's profitable enterprise customer base is using our software to deliver services through their portal interface, once that's been operating for a reasonable period of time, it's a very sticky revenue stream. It's not the sort of product that you could swap out easily. One of our customers said to us that we had to appreciate that they realized this was a 25-year commitment from them, and that's about right. Like all other enterprise software in any major corporation, once you commit to it, you commit to it for a long time. You certainly don't want to spend a lot of money and a lot of disruption to swap it out on a regular basis. And so for the people that say to me, are we just building web portals? No, we're not. This is an enterprise-grade solution that's deeply embedded into the operation of telco business. And then if we think about, well, what does a telco do with the product? These are the 10 core features that we offer a telco. And so when a customer has implemented our solution, these are the products that they can offer to their enterprise customers. And without delving into the detail, things like virtual cross connects, peering exchanges, network-to-network interconnection, network augmentation, GPU services, edge integration, cybersecurity, virtual services to the edge, subsea fiber connectivity and terrestrial fiber connectivity. These are the features that the telcos can then offer through the portal to their end users to generate revenue. And so each new feature that we build is another revenue earning opportunity for our telco customers. But for Activeport and Activeport shareholders, it's a license earning opportunity for us as well. Our customers pay for the product as a function of the number of network points that they have. And so a large telco might have 700, 800 major telco points. A small telco may have 20 or 30. Our software license is a function of the number of points. So $2,000 per network point per month, and scaling back from that. And then the telcos also pay us for feature set on top of those network points. And so there's a breadth factor to the licensing and a depth factor to the licensing. So each of these new features that we roll out is an opportunity for us to add more revenue on the consumption base for telco. And so we talk a lot about telco, but we take that software product and we sell it through 3 distinct channels. We sell it to telcos, we've just discussed. We have our own implementation of our software that we sell direct to the market, which is our SaaS platform. So same solution, just offering it direct to the ISP, MSP, and direct enterprise customers. And then we have our GPU variant of the orchestration product, which is all about delivering services to the consumer side of a telco. So when we think about enterprise telco licenses, on the left here, it's a $2.9 trillion industry in telco. Our target addressable market, we estimate for our orchestration software is around $65 billion. So this is a very big market for us. But it's all about the enterprise revenue for a telco. And if you think about Telstra, they have $25 million of revenue, maybe 5 of that is enterprise. And it's that enterprise portion that we're focused on here, which we think is about $65 billion TAM. Over here in the GPU world, we're talking about the mobile side of a telco network, and so it's the retail side. We feel that for the portion of that we do, which is the gaming and streaming piece, it's around about $9 billion as a TAM. And then the direct, what we would call MSP, ISP, so tier 2 telco, and direct enterprise customers, we think the target addressable market there for us is around $21 billion. So this is taking our software product, selling it through 3 different channels, and each of those channels is a very, very sizable industry. And so we've got a lot of headroom to scale the business and generate as much revenue as we possibly can. And so if I look at the growth in the sales pipeline, we've come out of the gates very quickly. We've averaged $6 million of software revenue year on year for the last 2 years, and that's coming off the year before where we had 0, which has been quite exciting for us. But when you look at scalability, it's really coming from 3 major projects. We think that we will be able to return another $5 million from those 3 customers in the next 12 months. But in behind that, we have 6 new customers we're rolling out at the moment. And I was looking at the numbers earlier today. two of these customers are two of the largest telcos in India, and a telco in India is a fairly large organization. I mean, the second largest telco in India, sorry, the third largest telco in India has 220 million customers. The largest telco has 435 million customers. So these are big organizations, and two of those organizations are installing our software right now. So it's quite exciting that we've been very successful in the countries where our software has the opportunity to scale in terms of license revenue and deployment scope, well beyond any of the local telco customers could. The ARPU in those countries is a little bit lower, but from our perspective, we're not exposed to the ARPU of the customer base. For us, the product is based on the scope of deployment, and these are very big networks that we're installing our software across. Outside of India, we're also installing the product in a number of Southeast Asian telcos, and hopefully we'll land some opportunities in some Australian telcos too in FY25. And so if I think about just the immediate sales pipeline that we're working with in the telco sector at the moment, these are just the ones that we have existing relationships with and are working towards a deployment of. It totals 15 across our existing and new and our prospective customers for FY25. And if I think about the revenue that we could generate from those 15 customers over the next 2 years, the total potential addressable revenue in that quite constrained customer base is $20 million. Talk a little bit about our SaaS product, Global Edge. Now that we've finished the B2B side of the SaaS product, we feel that is a complete product, and so we're putting a lot of effort into marketing and generating some new business from this service. And so I would hope that $2 million revenue base and the 13 customers we already have in the wholesale side of this product, I'd hope to see that recurring revenue start to scale up quite rapidly over the next 3 or 4 quarters. As I said earlier, the GP for the on-net side of the product is 75%, so it's a very profitable SaaS business. The customers do use the product to buy third-party services, so a customer can come to Global Edge, they can connect to Azure, Google Cloud, they can buy data center services from Equinix and soon to be NextDC as well. They can buy AWS servers, they can buy Oracle Cloud services, they can buy Console Connect network services, and very importantly is they can buy Megaport services. And so the blended revenue for the SaaS business will be a combination of our on-net services and the margin we make on selling those third-party products through the Global Edge portal. And then lastly, the GPU channel. GPU, as I said, is used primarily for cloud gaming. We sell the cloud gaming product. We license it exclusively through our partner, Radian Arc. Radian Arc has 70+ telcos committed to using the product. This year alone, we've rolled out 12 new sites. And so we're rolling out at least one new site every month. Some of those sites are quite exciting. Some of the Indian opportunities for cloud gaming are significant just because the sheer number of users in that space. The thing about our GPU software is it's a full streaming stack. And so we work tightly with GPU, CPU, and encoder cards from AMD. The software enables a game publisher to publish their game direct to our customer base or to Radian Arc's customer base in the telco sector. Radian Arc's 70 telcos collectively have a mobile phone user base in excess of 2.8 billion consumers. And so when you think about the revenue opportunity for a game publisher, an indie game developer who wants to get the next Minecraft out to an audience, when we're finished version 3 of the software, a game publisher will be able to go straight to the portal, publish their game, and have immediate access to almost 3 billion consumers across the world. And that's a very, very powerful tool that we'll have delivered to that customer base. And so we hope to be able to really drive a different paradigm in cloud gaming and gaming in general, but by allowing the game developers to publish direct to the market, which is something they haven't been able to do before. To make that successful, we've had to make sure the software reaches a price point that is profitable in low ARPU countries in Southeast Asia, Middle East, India, and alike South America. Version 3 is the one that really packs a punch. Version 3 is the one where we've done a lot of work with at the driver level with AMD's hardware developers to make sure that the software is absolutely optimized from a price performance perspective. And so we know that it works. We've already had it in trials. I saw the guys playing Angry Birds at scale a few weeks ago, and so we know the software we've ticked all the technical hurdles that we have. We're now in deployment. We've rolled it out to the Google Cloud in Singapore. The report earlier this week is that that's 90% complete. If we head into trials in August, then I think by September we'll be able to show the market a very, very, very innovative cloud gaming platform based on Activeport software. And so when I think about phase 3 of our growth strategy, phase 1 was to find product market fit. Phase 2 was about delivering to customers and generating revenue and proving to everybody that we had found the right fit for the software, and I think we have. Phase 3 has a number of angles to it. We need to leverage regional partners, especially in India, Asia, and Africa, and the Middle East, to get traction in key markets and just be able to get our software to more telcos faster. We've got the opportunity to sort of make hay while the sun shines, and so we need to not just rely on our internal resources. We need to leverage partners in different parts of the world to be able to deal with the tier 1 telcos and tier 2 telcos in each country and get as many deployments up and running as we can. We've established a really solid partnership in the Middle East to achieve that, and I would hope that on top of the 15 telcos I was talking about earlier, that we had some more in the Middle East in the next quarter. We're doing the same in Africa. We're doing the same in parts of Asia, places like Vietnam. And then I would hope that somewhere in the back end of FY23, we can think about tackling the European telcos and the US telcos as well, the North American telcos. We've talked about deploying version 3 of the gaming software. I get very excited about that. Being a geek at heart, I'm very excited to see that rolled out in the current half. So stay tuned for more information there. Version 7 of our orchestration platform delivers some key features for high-performance enterprise users. We're very excited about that. And of course, the rollout of our B2B SaaS platform, which we started this month. We've got a lot of marketing coming out. We're thinking about the customers we can onboard to that now to get some really solid references into the retail B2B side of that platform. And so we're very excited about Global Edge as well in this phase of our growth. And so the major architectural shift in the structure of the organization in FY25 is to transition to a 100% software company. For the last 2 years, we've talked about software and we've talked about the MSP business. We're going to very rapidly roll the MSP business into the SaaS business. And so all the way through FY25, we will just be talking about software and the revenue we generate from that software across those 3 markets of telco, SaaS, and GPU orchestration. I think the market momentum we have at the moment is quite exciting, moving from no customers to 3 customers to 15 customers in 3 years, and then the sky really is the limit. I mean, there are 750 tier 1 telcos in the world, so we've really only just scratched the surface, and we're having a very, very high success rate, conversion rate. So we're very excited about the momentum we have in the market. We think we have a very, very strong technology lead in the telco sector for self-service provisioning of their networks, and certainly in the GPU orchestration sector, we are a long way ahead of a lot of competition or what competition is left in that space. And we're very, very tightly aligned with one of only 2 hardware vendors. And so I think we've got a very strong competitive mode and technical lead in all 3 of our key markets for our software products. And the focus for FY25 is not top-line revenue growth. The focus for FY25 is about building up that recurring revenue and being able to report that regular recurring revenue growth for the next 4 quarters. And with that, Alan, time for questions.
Thanks, Peter. Let's get the Q&A. I'll go first.
Okay. Yeah. Hey, Peter, it's Alex Sundage from Green Street. How are you?
Good. Thanks, Alex.
Just quickly on the SaaS portal, which sounds like it's been a bit of a sleeper, but it was part of the IPO story. But it's now up and running. But how do you grow that quickly? What's it going to take for this thing to go viral and generate, tens, if not hundreds of millions of dollars of revenue?
Well, the interesting thing about the SaaS portal is the reason we put on the back burner, probably for the last 18 months, was that we were being so successful in telco that we had to focus our resources in that space because that's a more profitable revenue stream for us and a less labor-intense revenue stream. So the SaaS product now, having finished it and launched it, we have the resources that we need to be able to deal with the hopeful influx of new customers by merging the MSP team into the SaaS team. That gives us a strong team of 30 plus technical people across delivery, support, engineering to be able to rapidly ramp up some new customers on the platform. The challenge with a SaaS platform for a network is what I call the rip and replace problem, is that if you're a customer with a network, some customers are ready for a network upgrade, and so they're great opportunities, and we'll seek out those customers first. But what we do want to try and do is find customers where we can overlay the cybersecurity features, the deep packet inspection features, the monitoring and SIEM features of the SaaS portal to an existing network, because we don't have to replace the existing network. We can generate revenue from those sorts of customers a lot faster. And so in the immediate term, what we're seeking are customers with existing networks where they can take the features of the product and overlay it to what they already have, and then think about swapping out some of the underlying tech later on. A good example of that is an oil and gas customer that we're dealing with in Asia. They have an existing Fortinet network. What we're going to do for them is put our what we call our SD internet solution in between the Fortinet device and the physical network, and that, without delving into the technical reasons why that's good, will give them an added level of resilience and reliability that they don't have with their current network. And the great thing about that is that we don't have to change anything. We just have to overlay our tech into the existing network infrastructure. So it's a really good example of the type of customer we'll be chasing to try and generate revenue from the SaaS platform quickly.
Thank you. Thanks, Alex and Peter. Question from Anonymous. I guess back in the early days, you bought $2 million of revenue with Future Broadband. What has happened with this company?
Future Broadband is still generating $2 million of revenue. Future Broadband is, we bought Future Broadband because we love Jason McCronis and the team that run it. They're very, very clever ISP operators, have been in the ISP industry for as long as the industry has existed. And we needed that expertise in our SaaS product. We liked the technology they have to enable us to do self-service ordering from NBN service providers, TPG, Vocus, NBN themselves. And so they already had a lot of API software capability for automated self-provisioning for on-net local loop purchasing in Australia. We haven't been able to leverage a lot of that until we reached the current version of the product. The current B2B Neo solution, our enterprise SaaS product, in the next point version. So if we think about the version we launched today as version 1, version 1.1 will have the ability for a customer to order local loop. So as well as getting the SD-WAN services and all the cloud routing capability and monitoring, etc., you can buy the physical internet connection as well. And so we will finally get the opportunity to leverage the tech that we bought with Future Broadband, because it's being built as we speak, being built into the B2B SaaS platform.
Thank you, Peter. Another one. Q4 cash flow was quite strong. Was there any abnormal or upfront weighted sales that skewed cash flows favourably, but won't repeat in Q1 FY25?
That's been the story of our lives for the last 8 quarters. We have, if you look at the revenue numbers and the cash flow numbers, like a sawtooth. We'll have feast and famine. A quarter where we'll receive $1 million from a client, or a quarter where we'll just have base run rate revenue of $2, $3, $4 million. So there's nothing abnormal about it. It is actually normal for us over the last 2 years to receive these large amounts of money. The one that came through in Q4 was our payment from Radiant Arc, which had been accumulating over time, and also recovering some capital we'd invested to roll out some of the telcos with the GPU streaming service. And so it wasn't abnormal, it was totally expected. It is, I mean, it's been great to be able to receive large amounts of money from our customers. I think last year in Q2, we received $2 million from one of our other clients. In Q3, we received a very large order from one of our channel partners. It's been the norm for us to have these sort of lumpy revenue and cash results. We're trying to get away from that. The one thing I would impress upon people is we're not chasing more of that. What we're trying to get to now, because we've found that product market fit, and we've got a really solid bunch of telcos that we're rolling the product out to at the moment. As we get the integration done and we get to first invoice, you start to see that recurring revenue base start to increase, and that'll be a lot more consistent than what we've had in the last 2 years.
Understand, thank you. Another question from Anonymous. Can you sort of explain or clarify what you mean by transitioning the MSP divisions to software?
Yeah, when you think about an MSP, they're very good at dealing with customer-facing problems. They're very good at dealing with service desk. They're very good at architecting and engineering new technical solutions that might be a combination of network and cloud and cybersecurity or whatever. That's the type of people we have in our MSP business. Now, up until we launched the retail B2B portal Neo, we didn't, in the software business, have a need for those skills. And so we sort of operated an MSP business over here that was doing its thing and doing it quite well. And then we had a software business over here, which was focused on ISPs and telco. Now that we've got the retail portal, the B2B portal, we need more of that MSP capability, because the B2B portal will generate a need for customer-facing technical support, problem resolution, ticketing, billing will be more granular, all the things that we do in the MSP business. And so it just makes sense for us to put the MSP resource base in under the SaaS product and make that a single business unit. We did think about carving the MSP business out, but then we'd have to go and employ a whole bunch of people and train them up to be able to deliver the support we need in the SaaS business, and that didn't make any sense. And so it just makes sense to put the MSP business and the SaaS business together, because what you end up with is a very strong customer support capability and delivery capability that's driving new revenue through a very unique product in the B2B portal. And so I think the combination of the MSP business and the SaaS business will be very successful.
Well, thanks, Brett. I guess that leads into another question. Yeah, clearly MSPs aren't for sale then.
No.
Got it. Question from Stephen Matthews here. The GPU channel offers an addressable market today of 2.8 billion customers. I guess, how does that translate to revenue for Activeport?
Yeah, for us, we currently make $1 million a year in license revenue from that segment, and that the way the contract's structured is, first of all, we're selling the cloud gaming version of that software through our partner Radiant Arc. We have an exclusive license agreement with them. There's a floor that is $1 million a year from Radiant Arc. Once we get more and more GPUs deployed, we should break through that floor and the revenue should start to grow incrementally. The license model is based on the number of GPU servers that we deploy, the physical number of servers that are deployed into the market. Now, Radiant Arc deploys the hardware, they buy it, they pay for it, they sell it to their customers, and they deploy it out to the telco sector. The more of that they do, the more revenue we generate from our software license that goes on top of those servers. The way Radiant Arc has operated to date is to gather up as much breadth. And so the 70 plus telcos that we're deploying to at the moment for them is a huge number of telcos to have accumulated in less than 2 years. We're running very fast to get eat through those and get them live. So we're up to 24, I think, at the moment out of 70. So we've got a long way to go, which is fantastic. As we get more, as those telcos then turn on the GPUs and start to accumulate cloud gaming customers, they need more GPUs. And as we keep rolling out GPUs, we keep getting more license revenue. There are some real what I'd call them standout customers in that group. When you think about cloud gaming, for us, license is a function of number of gamers, because number of gamers generates more need for GPUs. Some of the telcos, like the one that we're delivering at the moment, has 450 million consumers. I think they're chasing 100 million gamers. We're talking about a telco that's delivering more cloud gamers, 5 times Australia's population as cloud gamers. Just gamers, not total users on their network. Just the ones gaming is 5 times Australia's population. So if any of those are even remotely successful, the number of GPUs that Radian Arc will roll out will be significant, and therefore our license revenue will grow accordingly. So it's a very exciting market, but it's a very new market as well. People have been trying to get, just like Netflix took a long time to get to that point where everybody just watched video that way by default and through our DVD players. Cloud gaming is the same. It's going to take a little bit more time for the market to mature. Once it does, then most people won't be using Xboxes and PlayStations and Nintendo Switches and $4,000 PCs. It will just become normal to game in the cloud. And once we get to that point, then our software will really be able to hit its straps in terms of revenue generating capability.
Next question, more into probably together, but obviously current cash reserves, is it sufficient to have your growth plans, and obviously does that allude to a raise?
Yeah, we had over $1 million at the end of the last quarter, which is great. We've got facilities, which is great. We've got the right size team, which is fantastic. We will get to a point somewhere in the next half, maybe just after Christmas, where we've got so many projects happening concurrently that we'll have to start to move resources from one to the other. I'm hoping the revenue will kick in and we will be able to self-fund through that process. So right now we're comfortable. We don't want to fall into the trap of bringing on too much overhead and having a lot of redundancy. In the software industry, it's really easy to bring on a ton of people and have them all stand around watching 3 other people do the work. And so we want to grow into the market and maintain our profitability. And I think we're okay. We're pretty well balanced at the moment, but we're always we're always concerned that if we do suddenly get 3 times the number of telcos signed up and we've got to get them delivered quickly, that we may have to expand the resource base faster than we planned. But right now we're efficient. We're getting things done. Nobody's working so hard that they're burning out, and so we're comfortable at the moment.
But just to clarify a comment about your FY25 number, you expect revenues to be flat as you focus on investment integrations, or are you expecting strong top line growth? Some clarity.
Yeah, top line growth is great, but that's not the focus. The focus is recurring revenue base. A typical telco for us generates $1 million a year in recurring revenue. So when you think about software in the telco industry, a lot of companies are selling user-based SaaS products where you may have an ARPU of $3 a user. And so a customer might be paying $50,000 a year for the software license. In our case, it's an enterprise product like a telco would buy SAP or Oracle, and they spend a lot of money on those solutions. In our case, a medium-sized telco is spending between $50,000 and $150,000 a month on licenses. And so these are significant revenue earning opportunities for us, because that revenue for us is 99% GP. And so rather than chasing top line revenue by booking deals where we get big cash hits up front, looks great on the reports, looks great in the charts, but what we really need, and I think what a lot of investors are looking for us to do, is generate that recurring revenue base and show that growing exponentially. And that's what we're trying to achieve. It may mean that we don't get these big hits of cash and revenue like we've had in the last 2 years, which may mean the top line is flat or maybe increasing slowly. But what's really going to stand out in the next 12 months is that recurring revenue base, because each of these telcos that we're bringing on board at the moment have got a huge earning capacity for us. And so the more of that we do, the more cash we generate, the more we can fund growth internally. And I think another 12 months of this and we'll get to free cash flow positive as well.
But there is a perception of an arm's length relationship between Radiant Arc and Activeport involving yourself.
Yep.
How do you resolve this perceived conflict going forward?
It was unintentional. When Mark Middleton, our CTO, myself, and David Cook, the CEO of Radiant Arc, got together in 2020 before we listed Activeport, and David wanted to chase the cloud gaming market. There wasn't a solution that readily at hand, and we felt that we could build one. David then went and knocked it out of the park in terms of sales, and so Radiant Arc is something that grew from a random idea in 2020 in the middle of COVID to and some reference architecture hardware we got shipped to us from AMD. It's now grown to the place where most of the other people that were thinking about building that sort of cloud gaming product back in 2020 have left the playing field, and it's just us and NVIDIA. And that's a fantastic place to be. But the artifact is that we've got this beast now called Radiant Arc that we're sort of attached to in that particular part of our revenue. There's certainly a connection there, because we when you think about Activeport, and David and the guys at Radiant Arc built that business in conjunction with Activeport's products, so we grew up together is the best way of putting it. There's not a lot that we can do about that. It's a historic fact, and there's nothing wrong with it either, because we've got such a tight working relationship that it works out really well. The one thing I would say is, people have said to me over the years, why are the two companies together? Well, the fact is Activeport is a software engineering business, and the revenue we earn is 90% GP. Radiant Arc is a very capital intense business. To roll out some of these telcos, they have to invest hundreds of millions of dollars in hardware, GPUs, CPUs, servers, and that's not Activeport's business, that's Radiant Arc's business. And it's fundamentally different from a capital structure, a balance sheet structure, a gross profit structure. You couldn't get a business that's more diametrically opposed from a financial statements perspective as Radiant Arc is from Activeport. And so we don't have any intention of ever putting the two things in the same room. We have a really solid relationship, a very clear and public licensing agreement between the two organizations. We work really, really close together. We work well together. While everybody's making money out of it, I think we just keep doing more of that.
Thank you. In regards to Radiant Arc's strategy, how's that compared to the Pentanet strategy? And that is from a gaming facilitation.
Yeah, I think we started when Mark and I remember I was going to eye surgery, and I said to Mark, have a look at this cloud gaming thing. And he said, when I came out of surgery, he said he had a look at it at NVIDIA's hardware, and we decided collectively that you couldn't build a cloud gaming platform as an independent operator on NVIDIA's hardware, because NVIDIA sell a product that's shrink wrapped. NVIDIA build the GPUs, build all the component parts, and they build the software across the top of it, and they launched that to the market called GeForce Now. What Pentanet have is a licensing agreement to sell the GeForce Now product in Australia and New Zealand. And so they buy it for millions of dollars from NVIDIA, they deploy it, and they get subscribers and share the revenue with NVIDIA. And that's fantastic, because it's a really easy way to be a cloud gaming provider. We went to the only other supplier of GPUs in the world, being AMD, and had a look at their solution. And AMD is more like a Meccano kit. Yeah, I posted somewhere this week that NVIDIA is like Playmobil. You get it out of the box and you start playing with it because it's already prepackaged. When you go to AMD, it's like a Lego set. You get a box of parts and you've got to build it yourself before you can start playing with the toy. And so we went down the AMD path it was a lot harder because we had to build the software ourselves. But where we've got to now with AMD is that our software is, from a price point perspective, we're delivering a unit economic GPU capability for about $50,000 versus if you go to NVIDIA to buy GeForce now, you're probably spending $1 million to start. And so our price point is a lot more cost effective. So when we're chasing low ARPU countries, we are able to deliver into those markets and make a profit, or Radian Arc's able to make a profit in that space. And so our software enables Radian Arc to make a profit in those low ARPU countries at very, very high scale, which is a very difficult thing for NVIDIA to do because of the bulk and weight and size and scope of the GeForce Now product. It's a long way of saying that if you look at the cloud gaming platform market today, there's GeForce Now and there's Activeport on AMD, and it's very, very quickly becoming a two-horse race between those two platforms. So when people say, what's the difference between Pentnet and Activeport cloud gaming? Pentnet buys a product, shrink wrap from NVIDIA, deploy it and operate it. Activeport actually builds the product. We build the technology that delivers the AMD equivalent solution in the cloud gaming sector.
Another one from Stephen. What's the dollar amount invested in Radian Arc, and what percentage of Radian Arc equity is today? And I guess could Activeport buy more equity in Radian Arc?
Could we what, Radian Arc?
Could you buy more equity in Radian Arc?
The answer to that is the actual cash invested is zero. In fact, it's positive in the Activeport direction. It started off the other way. We did, as Activeport, invest in Radian Arc's deployment. So we helped buy some hardware. We helped a lot of the early stage setup for some of the telcos, which was great. That's all been repaid. So we don't have any residual, or Radian Arc's got no residual obligation of paying anything to Activeport. We don't have any net cash invested in Radian Arc. So it's very clean from that perspective. The final washout of that initial setup phase was that we ended up with an equity stake between Activeport, ended up with an equity stake in Radian Arc, which is fantastic. We don't have any plans to do any more of that. I think from here, Activeport has found its niche in the market across its 3 different software channels. One of those is the GPU orchestration for cloud gaming with Radian Arc. Radian Arc has definitely found its feet in the cloud gaming sector and is working very hard in the AI space as well at the moment. And so there's no real dependency between the two businesses anymore, except that we license our core tech to Radian Arc for them to be able to deliver their platform to the telcos. The one thing that I would say is that we do work closely with the Radian Arc sales team to open up opportunities in the gaming. The telcos that are port gaming, we leverage that to then deliver our software to the enterprise side of some of those telcos for orchestration, which is a fantastic relationship because there's really good synergies between the two businesses. But financially, there's no real dependency between either of us on each other. It's just the overlap now is just the technical side.
Got it. Okay, so just to clarify, Pete, so what is the percentage stake that you have in Radian Arc?
It's not substantial, and I don't actually know the real percent, but it's less than 5%.
Good. Okay, I'll come back on that. Okay, perfect. And I guess just to clarify, you mentioned about the full debt for Radian Arc, that's fully paid, correct?
Yes, that was that somebody alluded earlier to what was that big cash amount. That's what that was.
Okay, thank you.
And Peter, Alexander again, just Megaport's been mentioned a few times here. Can you just clarify the relationship with Megaport currently in commercial terms of the relationship, and speak to me in very simple terms, like I'm a 10-year-old.
One of the very first things, Megaport, for people that don't understand, offer a network as a service. So you can go to, if you want to build if you're an enterprise customer, you want to connect your Sydney data center to your Dallas data center, That used to be a very expensive, difficult process. Megaport built a product called Network as a Service. That means you can go to the Megaport portal, register your account, give them your credit card, and you can, within minutes, have a data connection between one data center in one part of the world and another data center in another part of the world.
Yeah.
The manual interface for that is the Megaport website. The automated back office interface for that is what we call their API. Our Activeport software has been able to talk to that Megaport API from day one. It was one of the first things that we ever built. And so any of our customers, whether it's a telco or one of our B2B portal customers, they can use the Activeport software to buy Megaport products and configure services on the Megaport network. And Megaport has a lot of partners that do that, and they pay a channel partner commission for those products that we sell on their network. And so that's the essence of the relationship with Megaport. Is we're a channel partner or a reseller partner for Megaport, and we're one of the technical partners they have, that our software talks to their software direct, so that we can have our customers buy Megaport product and take advantage of Megaport's network as a service to extend the scope of their network. Now, for an enterprise customer, that's sort of standard. For a telco, that's a little bit different. If you're and we're doing this for a few telcos in the world at the moment, if you're a telco in, say, Indonesia or Malaysia or Australia, you typically have a very, very strong national network and a very thin international network. One telco I can think of has got pretty much the entire country wired with fiber, but they only have 10 network points outside of the country. So one in LA, one in Sydney, one in Paris. There's only 10 of those compared to the 4,000 network points they've got in country. What we're doing for some of those telcos is using our Megaport API to enable the telco to extend the reach of their domestic network by leveraging Megaport's network. And there's a bunch of technical challenges in doing that. What it should mean is that we can bring a lot of new telco revenue from our enterprise telco customers through onto the Megaport network, so that they can offer, the telcos can then offer customers that they otherwise didn't have a solution for, access to parts of the world across Megaport's network that they've now got direct access to. And so we think that that will be a very successful market for both the telcos, because it gives them more revenue, but hopefully for Megaport as well, as our favorite partner. We hope that we can bring a lot more traffic onto the Megaport network by introducing, rather than just one-off enterprise customers, which are great but small, we should be able to introduce entire telcos to that network through this API. And so it's one of the things that I've wanted to see done from day one. We're now building up enough deployed live national telcos using our orchestration software that we can start to test the economics of it and the feasibility of it and see what revenue does actually flow through that channel. But I'm hoping that in December, January timeframe, we should have the first of these major telcos using that API interface between Activeport software and Megaport's network to be able to buy services from Megaport.
Fantastic. Thanks, Peter. Just conscious of time. Thanks again. Good work on the quarterly, and we look forward to the full year. If there are any further questions, feel free to reach out to myself or the broader team. Again, this is recorded, so I'll reach out to you individually for further distribution. Peter, thanks again. Everyone, thanks again for attending.
Thanks, everyone. Talk soon. Bye.